Thanks so much, and my thanks to Olivia for organizing this extraordinary conference each year and for inviting me this year. I was not one of those who deserved thanks for delivering a paper on time, but I am one of those speakers who will express my deep gratitude to Olivia and the Pension Research Council for all the extraordinary work they do. I'm also going to start this conference by being a little different. And that is, I'm a financial historian, not an economist, and so I'm going to be talking a little bit about the history and context, institutionally and by personality, of Fed independence and what it means for our current low interest rate environment. So we have developed over the course of the second half of the 20th century, but especially in the 1980s and 90s, an account of what we mean when we say a central bank is independent or the Federal Reserve is independent. It goes something like this. There's a legal separation, right, by statute or by treaty between politicians, and usually we're talking about a president or prime minister, the one facing the national electorate, and central bankers, and here again we talk about people, Janet Yellen, her predecessors, Ben Bernanke or Alan Greenspan, and the like. And we create that legal separation because we have in mind that price stability is a scientific enterprise. So maintaining the integrity and value of currency is something we hand over to the scientists and engineers of the central bank. And unlike scientists and engineers at, say, NASA, where the president will have very good incentives to see them succeed, he doesn't want to have shuttles exploding and the like, the president is interested in manipulating the value of currency. And the idea there is that presidents want to be reelected, or if they're termed out, they want to preserve their legacy. And they'll do this authentically or they'll do it on the cheap. And if they do it on the cheap, it's by running the printing press and inviting hyperinflation in the hopes of tricking the electorate into a time consistency problem they'll resolve in their short-term interests. And so central bank independence is a mechanism of law to block the president from meddling, right? The metaphors go tumbling forth from here. It's a Ulysses contract, right? Ulysses contract. And we remember this story from Homer's Odyssey, lashing Ulysses to the mast and stuffing beeswax into the ears of his oarsmen so that Odysseus could hear the siren song without ruining the ship. Now, in this metaphor, central bankers are the oarswomen and oarsmen, law doing the work of the beeswax and the lashes for our politicians, keeping them in place. We, the people, are the sirens in this metaphor. Now, fast forward a few millennia, and we get something else, and that is from William McChesney Martin. More about him in a moment. But the Fed is in the position to chaperone who's ordered the punch bowl removed just when the parties weren't right up. Have you heard this before, the punch bowl metaphor? It's very common. It was spoken first in 1955, but really exploded in the 1980s as a justification for having these remarkable institutions be autonomous from the rest of government. Incidentally, if you do a Google image search for someone taking a punch bowl away, you'll find more instances of people spiking the punch bowl. Not inappropriate given central bank policy in the last decade. So what does this mean for long-term interest rates? Well, interestingly, this metaphor, this idea, the standard account of central bank independence, I argue in a book published last year that each of these features we're talking about, the laws doing the work here, that the president is the one who's trying to meddle with central bank policy, that a central bank can be reduced to a single personality, that price stability motivates the work of central banking, and that it's a technocratic skill exclusively. Each of those five elements, I argue, is false. False either because incomplete or false because simply untrue. But where does it come from? Well, in part it comes from the author of the punch bowl metaphor, William McChesney Martin. And why does this matter for the current long-term interest rate environment? Well, the Fed built over decades, but especially after Paul Volcker came onto the scene, as the only game in town for combating inflation. And the dynamics of inflation are, even among experts, difficult to pin down. This is an ongoing debate. What exactly was the nature of the Great Inflation and the subsequent Great Moderation? Economic historians continue to fight and argue about this. But the public was told aggressively by central bankers, including folks like Paul Volcker, that the Fed was the only game in town, that they were the ones who had the control over interest rates to take punch bowls away, to enforce that Ulysses contract. And so now we find ourselves in an environment where the interest rates have been low, very low, for a long time. And I argue in this paper that what we see then is, by virtue of a relatively stunning success on the mandate for the Federal Reserve in particular for price stability, we have forgotten the Fed's third mandate. We talk about the Fed having a dual mandate, but this is, legally speaking, false. There are three mandates in the same sentence. You don't know what the third mandate is? So central bank trivia. It's not, we know price stability, we know maximum employment. The third is moderate long-term interest rates. Right? And by no one's definition would zero be moderate. Right? And so the question then is, what position is the Fed in today, having made promises over decades about its control, not over nominal interest rates. A nominal real distinction is often lost in the political discussions about the structure of central banks, over interest rates in general. So again, as I think that this account has done important work in understanding exactly what the relationship is between central banking and the rest of the political system. But again, I think that it is inadequate to the post-2008 world. I think it's inadequate in the pre-2008 world. It was a public education system that was extraordinarily useful coming off of the Great Inflation, instituted in part by Paul Volcker, accelerated by the maestro himself, Alan Greenspan. But we're now in a world where the time consistency problem must be resolved in a different way, right? That, by the way, is my subliminal advertisement for my book, where you're going to learn so much more, not so subliminal now that I've paused on it, but learn so much more about why I think central bank independence, especially with respect to the Federal Reserve, has been reduced to an essentially incoherent concept without much analytical content. What does it mean for the Fed today? Well, this is something that if Ben Bernanke were in the room, he would be grimacing a little at some of my characterizations, but mostly nodding, because Ben Bernanke, more than any of his predecessors, tried to do a different kind of public education regime, whereby he was trying to teach about, although not necessarily in these words, about Wickselian interest rates. This is Knut Wicksell. The idea that the Fed does not dictate to markets interest rates, real interest rates. Right? And this is widely accepted among economists. Nominal interest rates, sure, but the real interest rates that reflect the productive capacity of an economy, based on so many different factors, is not for the Fed to dictate, but is for the Fed to discover and try to ensure that the nominal interest rate that the Fed does have more control over, although even they're not complete control, isn't so out of sync as to wreck the economy in either an inflationary or deflationary direction. So the Fed's work then is to discover that Wickselian interest rate and try to get the nominal interest rate as close as possible. Can the Fed, what is the Fed up against today? Well, that's what we're meeting over the next day and a half to discuss, these secular trends of real interest rates falling even into negative territory. And so what does that do to the political economy? Well, remember that in the metaphor of what I call the Ulysses chaperone conception of Fed independence, it's the populace clamoring for inflation. And we even have in our history elegant examples of extraordinary speakers decrying the influence of hard money conservatives at the expense of the public. Here's William Jennings Bryan, ran for president under the Democratic banner 4 times in the late 19th and early 20th century. That was his view. Where do the populists stand today? Right? I would say that the legacy of William Jennings Bryan isn't in celebrating the Federal Reserve's low interest rate policy, but in berating it. You could even go by congressional district and see how those politics have been inverted. Why? Have the public been sold a bill of goods by their politicians? Have they been told that indeed they should be clamoring for interest rate policy that's inconsistent with economic growth? I'm not sure that's true. I think that they've been sold a story that now the Fed chairs are sprinting in the opposite direction to try and reduce, that the Fed is all powerful, that the Fed has the final answers, that again, the Fed is the only game in town. Interestingly, I used this book cover from Muhammad El-Arian. The only game in town, though, is a quote from Paul Volcker in telling Ronald Reagan in the early 1980s why it was essential for the Fed not to be reduced to an algorithm or to a gold standard or to Treasury cooptation, because only the Fed could combat inflation. So I think the public is responding to that. And if you look at a Federal Reserve in that lens and think that the Fed has complete economic control and can, through its extraordinary levers of power, dictate real interest rates, the question immediately becomes, what the hell is happening to my 401k, right? Why are interest rates so low? If I'm on a fixed income, why isn't the Fed nudging this upward? What about the consequences for retirees versus those who might enjoy their financial thrills through market volatility? That is the argument, that is the discussion. And that means something very important for the political economy of the Federal Reserve and the Federal Reserve Coalition. The Fed is in the extraordinary position of having just celebrated its centennial. Its predecessors as government-sponsored banks saw no such centennial. And part of the reason that the Fed has been so successful isn't that it hasn't been challenged. Indeed, throughout that century, it's been extraordinarily controversial. It's succeeded because it's built a coalition that has not been divided so evenly between the political parties. Now we are saying, how am I doing? Oh, all right. I've been speaking for 1 minute, or I've got 1 minute left. So what then for the future? Well, the Fed's popularity used to be second only to the Center for Disease Control. So now it is second only in public disgust to the IRS. Much of that has to do with bailouts and the immediate response to the crisis. But much of it, too, is about public confusion of what the Fed can do vis-a-vis these low interest rates. And so that is part of our job as academics, is to tease that out. But I think the central bank's and the Fed's job to essentially launch a re-education tour to explain why this idea of central bankers as maestros, as the Fed as the only game in town, as the great economic emperors of interest rates, was not true then, it's not true today, and that leaves us with the hard problems of trying to figure out then what will the Fed do, like the rest of us, in reaction to this market uncertainty about secular, long-term secular trends in interest rates. Thank you very much.